We're delighted to welcome you to our next update of the EU Direct Tax Briefing. My name is Sasha Kerins and I'm an international tax partner with Grant Thornton Ireland.
And my name is Monique Pisters and I'm an international tax partner from GT in the Netherlands. And today we will be talking with you around the move from ATAD 3 to refining DAC 6, the decluttering agenda and the agreement with the G7 and the US on Pillar 2.
So Monique, firstly talk to me a little bit about the shift towards modifying DAC 6 instead of pursuing what was obviously ATAD 3 and how that reflects the broader trends from an EU policy perspective.
Yeah, so really the move from ATAD 3 to refining DAC 6 is really a strategic move of the EU and demonstrating more regulatory pragmatism and efficiency. If you look at DAC 6, we have it since 2016. Mm-hmm. It's incorporated in the systems of the EU member states. Tax authorities and intermediaries are used to it. So modifying DAC 6 really makes sense. And it's also in alignment with the decluttering agenda of the EU. So modifying existing frameworks instead of constantly incorporating new agreements. And although conceptually ATAD 3 was a good directive, the Unshell directive, mm-hmm. there was a lot of criticism in literature that it was complex and it was really burdensome for businesses. So with this move, it really marks a trend that the EU is looking more towards principle-based legislation. So
yeah, it seems positive. But talk to me a little bit about how they're going to kind of incorporate some of the indicators and the hallmarks that are a key aspect to ATAD 3 into DAC 6 potentially.
Yeah. So to effectively still combat the misuse of shell entities, I personally feel that the new hallmarks will be substance focused. Mm-hmm. Indicators, for instance, could be whether there are actual operational activities in a country, whether they have local employees, and whether the decision-making power is actually in that jurisdiction. But you can also think of the absence of financial risk or commercial rationale behind the structure. That could serve as a true red flag. Another hallmark would be, for instance, if companies use the same structure across multiple jurisdictions with the same directors and the same addresses. That could be a red flag of an artificial structure. But also passive flows of interest and royalties, for instance, without the recipient having the actual substance to manage those underlying assets properly. And finally, but foremost, I think we will also be seeing more reporting on the ultimate beneficial owner of a structure. Mm-hmm. All in all, I guess these hallmarks will have to balance between precision and practicality. So the tax authorities will still have to be able to detect the misuse. But on the other hand, you want to avoid too much legislation and compliance burdens for companies.
So really we have a number of hallmarks already within DAC 6. We're probably going to see those being expanded to deal and capture some of the key items from ATAD 3. And I suppose the key point is how they bring all that together for consistency of application is really important. And do you see the shift really as a win towards tax simplification? We've been talking about ATAD 3 for quite a long time now, you and I.
Yeah.
So obviously, what's your view on that?
Yeah, we've been talking on this since 2021 when it was first introduced, I still remember. Well, Sasha, to be honest, I think it can be both. It can represent a win for simplification, but it's also a potential risk for the enforcement. Building on DAC 6 avoids that we have to do yet another directive with new compliance obligations, new forms. So leveraging on the infrastructure, which we already have, does make sense from my perspective. But I guess whether it will also be an enforcement risk will mainly depend on how effective and robust these hallmarks will be. Mm-hmm. If the hallmarks will be robust and really substance-driven, then I think there's a good success that we can meet the decluttering agenda, having not an additional new frameworks, but leveraging on the existing ones. But if the new hallmarks are vague and open for interpretation or too cautious, then I feel there's a risk the tax authorities will lack enforcement power.
Yeah, and that's already a feedback from the DAC consultation around DAC 6 is the lack of consistent application of interpretation of DAC 6 consistently across the EU member states, different level of penalties. So a number of things that kind of still need to be tackled there. The concept is great, but the practical application here is really important.
Yeah.
So in that context, Monique, how should tax advisors and stakeholders prepare for the potential change?
Yeah. So there are a couple of things one should do. So the consultation process is now ongoing on what these new hallmarks would be. So I would recommend to closely follow those to stay ahead of the game, basically. Also, I feel that advisors, but also in-house tax teams who also already have a DAC 6 infrastructure should really evaluate whether this infrastructure also accommodates changes in hallmarks. Are they flexible? Are they agile? Can they be amended? Of course, as mentioned, ultimate beneficial owner tracker. So I think they should also invest in documentation and data tracking to ensure that when these new hallmarks are there, they can easily track where is my ultimate beneficial owner? Do I have cross-border flows? How are my operational activities? Those types of things. If you have legacy structures where you doubt whether they have sufficient substance, then I think that is the time to reassess those structures and to have a close look at them. And finally, I think cross-functional collaboration between tax, legal and compliance teams will be more than ever necessary, because these new hallmarks, as I discussed, will affect onboarding, risk assessment, etc. So this collaboration between those three disciplines will be very key. It's important, again, that this is not just a technical update of DAC 6, which is now coming through. It's a really strategic move towards more principle-based legislation. And like I say, it's important to stay ahead of the game so that clients and advisors are not surprised.
So lots to do and keep watching.
Yes.
Excellent, Monique, as always.
Okay, so Sasha, I talked a little bit about decluttering. I'm sure some of the viewers are like, what is she talking about? So could you shed a little bit more light on decluttering in the context of the EU and why it is gaining momentum right now?
Yeah, so decluttering is effectively the simplification and modernisation of EU's complex and often overlapping tax framework, very much driven by what people would remember being the Draghi report in 2024. The aim being really to take out kind of old provisions that are no longer fit for purpose, duplication of legislation, but also to address the cohesiveness between the implementation of directives and then the interpretation of those directives at a member state level. So, you know, the whole idea of trying to streamline direct tax policy across the EU is a real focus here. And I suppose the question is, why now? Well, probably three key reasons for that. Firstly, we're seeing a significant amount of reporting layering. So obviously we've seen the changes that have come in as a result of the ATADs. We're obviously seeing the Pillar 2 legislation being introduced, OECD guidance, administrative guidance, EU directives, local jurisdictional implementation and interpretation. Obviously the increased reporting under things like DAC 7. So really a huge burden on businesses in relation to what we're seeing within the existing frameworks. Secondly, the digital economy. And we've been talking about this for a long period of time and the impact of cross-border business. So really some of the existing pieces of legislation just aren't fit for purpose. One being the interpretation of permanent establishments. Yeah. You know, the interpretation of what that means for the movement of people and how those businesses actually need to transact and do their business. So that's a real challenge, and there's a modernisation required there. And finally, competitiveness. The EU wants to be a go-to place for business. Yeah. And not just for large-scale multinationals, a lot of them have the systems and processes to deal with some of these layerings, but for scaling SMEs, you know, having a place in Europe and being attractive from a European perspective is really important. And we've seen the likes of organisations that have started really small and their ability to scale exponentially now, particularly those in the digital world. So I think the EU is very focused to ensure that it has a system that can attract those type of businesses within the single market. So really, I think, you know, we're seeing decluttering not just as a technical requirement, but really as a strategic priority for the EU if it's going to remain competitive.
Yeah, good point, because we see that debate going on, right, in the businesses we are doing with clients, where we are losing ground in terms of compliance and competitiveness thereof. So in light of that, do you foresee a future where the EU will have more principle-based legislation instead of the rule-heavy ones we saw in the past?
I think we're kind of already there. We are seeing a real shift. I suppose the historic legislation from an EU perspective has been quite rules-based, quite dense, and there's a real focus on now that it's more focused on intent and substance, with an idea of fairness, flexibility, but also economic reality. Again, the change and shift in businesses requiring tax authorities to be flexible, and those dense rules really aren't fit for purpose in that regard. Yeah. Back again to the level of rules I just alluded to from a Pillar 2 perspective, it's significant for businesses, but significant for tax authorities. And the whole idea for businesses is you want transparency, fairness, but also a level of trust within the system and clarity around interpretation. So I think we're there. We're also seeing a significant amount of court decisions having a focus on substance as opposed to principle form. So I think the focus around box ticking and layers and layers of filing requirements, trying to achieve one particular objective, there needs to be a more cohesive approach. Yeah. Now the challenge around that is there's probably going to be a little bit of concern around consistency of interpretation. Yeah. But really what we need to see is clear guidelines and consistent implementation of court decisions. And that's something we've been looking for from an EU perspective in relation to the implementation of directives. That we're seeing multiple interpretations across EU member states dealing with lack of consistency of implementation and really causing a serious amount of red tape. Yeah. And cost.
And cost, yeah, not to forget. Yeah, agree. So you touched base on Pillar 2 before. Of course, there isn't a webinar where we cannot give attention to Pillar 2. Of course, there's recently been an agreement between the G7 and the US on Pillar 2. Can you give us some insights on what your initial thoughts on that agreement are and the impact and consequences it will have?
There's potentially significant impact for us as to where we are. I suppose just to step back, what's really been talked about here is the fact that for US-based multinationals, that there would be no top-up tax at an income inclusion rule level or at an under-tax payment rule perspective. Two key concepts of the whole Pillar 2 model. And I suppose the US is not seeing this as they're seeing this as a carve-out. They're not seeing this as an exemption because under their interpretation of the rules, they already have the guilty provisions. These have slightly been changed, obviously, under the new bill at a US level. But the rule, their ultimate interpretation is that guilty provisions achieve the same as the Pillar 2 rules. Now, we do know, from a technical perspective, which we're not going to get into today, the basis on which guilty is calculated and the basis on which Pillar 2 is calculated is totally different. So the challenge here is that we could have a carve-out potentially for US headquartered multinationals, but looking at that from an EU perspective and an implementation perspective, what does that mean for multinationals based in different jurisdictions? The whole basis of Pillar 2 was that we had a global system. There was consensus on how it was going to be adopted and adopted consistently across the globe, with the aim being, there was a minimum top-up tax of 15% at a jurisdiction to jurisdiction level. And now potentially we have a potential other set of rules from a US perspective that now sit alongside that. Yeah. And standing back, there was 138 countries that agreed to implement Pillar 2. Yeah. As of today, we haven't seen 138 countries implement Pillar 2, but already Pillar 2 is in effect for the 27 EU member states, effective from 1 January 2024. So we're really at a crux of a position as to what does this mean now. I think it's really important to remember this was talked about at the G7. There's no legislation here. No. We don't have a lot of the details. The EU is obviously represented at a G7 level by France, Germany and Italy. Yeah. But certainly there's not consensus, as we were aware, across the 27 member states in relation to adopting this type of agreement with the US. So as we stand today, the rules still sit where they are from the point of view of Pillar 2, and there's obviously certain transitional rules and safe harbours that impact and can benefit multinational groups for a period of years. So it's really watch this space. I suppose one of the key aspects that has been agreed to at a US level is, to the extent there is qualifying domestic minimum top-up taxes at a local jurisdictional level, that will be respected in relation to ensuring that at a local level there's a minimum effective rate of 15%. Mm-hmm. But I suppose the framework on which Pillar 2 has been built, which is a consistent framework globally, is now at risk.
Yeah, I agree with you. And also the G7 agreement still leaves room for interpretation a lot. Like, is it only US parented groups or also groups which are not US parented for which the so-called carve out is meant? So I guess we have to keep a close watch of what will go on there and how the EU will respond, I guess.
Exactly, but as we sit here today, just to reiterate, for US headquartered multinationals, to the extent they have operations within jurisdictions that have adopted Pillar 2, there is filing requirements coming.
Definitely.
Year ends from 1st of January 2024 onwards are in scope. We are talking to those. We are carrying out transitional safe harbour calculations. We are looking at qualifying domestic minimum top-up calculations. So businesses, I think, have to continue to prepare that there's going to be an element of reporting and filing required. The level of what that might be might change, but obviously we have rules in place for 2024 that need to be considered. And I suppose maybe the where we may end up post-transitional safe harbour maybe is a different scheme, but I think it'd be very short-sighted now to stop any Pillar 2 planning.
No. Totally agree.
And I suppose there's a challenge from an EU perspective, going back to the consistency point, is the harmonisation across the EU from a Pillar 2 perspective. So we talked about the layering. Obviously, the directive has been consistently implemented across the EU in relation to the implementation of Pillar 2. But again, when we look at the consistency of interpretation, we have countries like Belgium. They were the first to require you to issue a notification back in 2024. The intention for Pillar 2 was to give businesses and tax authorities time to deal with the implementation of Pillar 2 at a local level, was that it would be filing 18 months after the year end. So effectively June 2026 for 24 year ends would be the kind of the first date. But we're seeing Belgium with a requirement for QDMTT filings by November. So that's a real challenge for businesses, because a lot of the basis on which Pillar 2 is being looked at initial basis, as you know, is based on the CBCR data. Historically, CBCR data did not need to be ready until 12 months after the year end. So for 24 year ends December 2025, but yet we have a filing requirement in Belgium in November. So things like that don't help in relation to, facilitating businesses' consistency and trust in the system.
Because that was basically also my last question. Like, you talked about decluttering, but is there a risk that in light of decluttering, that the implementation of Pillar 2 might actually lead to more complexity?
I think there's a significant amount of complexity within Pillar 2. There's a significant amount of complexity within the interpretation of Pillar 2 and the consistent interpretation. And we've got layers and layers and layers of guidelines supporting Pillar 2, because it's a really complicated framework and piece of legislation, and is obviously trying to sit within existing frameworks on a global basis. So, when we talked about it the last time, we said, Pillar 2 is going to be evolving. And I think, this G7 discussion and where we sit today is just one example of that. It doesn't help businesses who are trying to put budgets together for the 2024-25 filings, unfortunately, from a client perspective. But we're very attuned within Grant Thornton globally to what's happening in Pillar 2. We're there to support our clients. And I think, having a practical approach to how to deal with this at the moment is really important. I suppose, the EU's focus on decluttering, going back to your question, is needed. But obviously now they're being impacted what's happening at a global level. And that's a balance that they're going to have to find. And I know it's a focus of the current presidency within the EU, but ongoing discussions are needed to see where they end up.
Interesting, and then of course the clients have us to stay on top of the game.
Absolutely.
And inform them about the developments we see in the market.
Yeah.